Welcome everyone, and thanks for joining us for iCM's third quarter 2026 quarterly market insights presentation. I'm Ryan Lehman, iCM's Director of Investments, and I'm going to be your host for today's presentation. So just thinking about the key themes for this quarter's presentation, starting with the economy, we'll talk about some implications from the Iran war and how that's impacting inflation and the future path of interest rates. On the rate front, we'll look at how rising inflation expectations have impacted the yield curve and where we're finding opportunities today. We'll also look at the current credit environment and dive into how the volatility around the war has impacted spreads. And then last, on the equity front, big theme for this quarter is going to be concentration risk within not only the US but global markets, and how this only serves to magnify the risk of high valuations today. But despite US growth stocks in the AI trade looking a little bit frothy, there are some really attractive relative value opportunities out there, and we'll walk through all of those. So with that, let's go ahead and jump right into things. Just one quick disclosure here before we get going. And let's kick things off here with the economy. So starting off with inflation, it's really no surprise that inflation has risen since the start of the Iran conflict. Energy prices are a key component of the headline CPI reading, and with WTI soaring from less than $60 a barrel at the start of the year to over $110 at its peak, this is clearly going to result in a higher price index, and that's exactly what you see on this slide. Our last reading on the year-over-year number for headline CPI that came in at 4.2%. It's going to be the highest level that we've seen in the last few years. However, this was largely driven by the energy component, which you're going to see in this chart in the green color. Now, since we've seen energy prices come down the last month and a half or so, the general expectation is that this bout of inflation is indeed going to be transitory. And I know transitory is a bit of a dirty word after 2022, but this time around, it does appear to be accurate. The reason for that is that this is purely a supply side shock. It's not that perfect storm of supply disruptions and excess demand like we saw in 2022. Once that supply does start to come back online, price pressures should begin to ease. It just hasn't shown up in the data yet. And just for the sake of example, if we were to just back out some of these short-term price pressures, the May reading, it really wasn't all that bad. The headline number, like I mentioned already, that was 4.2. But if you zero out those energy gains, you zero out the pretty significant rise in airline fares, you would have been at roughly 2.5%. So still above the Fed's target of 2, but much more in line with where we were prior to the start of the Iran conflict. So sticking with that transitory theme, I think this slide gives you a good idea of the market's view on the transitory nature of the current inflation spike. So we're looking at break-even inflation rates for 2 and 10-year tips. And just for a bit of reference, this is market-derived data about where the market is pricing future inflation. And there's really two key observations here. So first, the long-term expectations, they've barely budged despite the war. And second, you're going to see that large upward move in the near-term number right after the war broke out. But that's essentially collapsed since we've seen some resolution. In fact, the 2-year break-evens, they actually ended the quarter at just around 2%, which is actually 30 basis points lower than where we started the year. So at least in the minds of investors, they are expecting inflation to come back down to earth in the near term. And it looks like any lingering fears at this point, they've at least started to fade. Now, to speak to why expectations are declining, it's not just oil coming down, but it's the fact that supply is coming back online, albeit slowly at this point. This slide shows what we like to call the Strait of Hormuz traffic report. And what you'll see is that prior to the war, upwards of 140 vessels per day were making their way through the strait. When the war broke out, traffic essentially came to a complete halt, with 0 vessels actually moving through the strait on a handful of those days. However, as we work toward resolution, you can see traffic resume in mid-June or so. And although we're still pretty well below historic norms, the trend is pretty encouraging and should continue to provide relief to energy markets, assuming the negotiations continue to remain on track. Now, switching gears to jobs, because as we know, the Fed does have a dual mandate. Here we're going to see some key labor market data. So if we start with JOLTS on the right, You're going to see a clear drop off from the labor market tight levels of early 2022. However, all three metrics on the slide still indicate a pretty healthy and well functioning jobs market. The openings rate, that's been ticking up despite all the fears around AI taking jobs. Layoffs, they remain low. And then the quits rate is still at a pretty healthy level. Then on the left pane, you're going to see the monthly non-farm payrolls data. We had a bit of a miss on the last report, and there is some speculation about the World Cup driving strong leisure hiring 2 months ago. But all in all, the 3-month trend is still relatively positive. So taking everything we've talked about together, the Fed's in a bit of a bind here in terms of their ability to cut rates, at least in the near term. Labor markets look to be on relatively strong footing, and inflation, at least on a backward looking basis, is still pretty hot and clearly above their target. But what I want to do next is we'll go ahead and defer to the folks who are actually making those decisions. So the data on this slide, this is coming directly from the Fed. So we have estimates from the SEP as well as the dot plot. And not surprisingly, you're going to see a pretty hawkish tilt, especially since the start of the Iran war. So starting with the SEP, estimates for inflation, they have gone up pretty dramatically. So looking at the core PCE, which tends to be the metric the Fed likes to target, their estimate has moved up from 2.7% in March to 3.3% in June. And this ties out directly to the shift that we see in the dot plot. So at the March meeting, general consensus here, the median dot was 3.375% by the end of the year. That is actually below where we are today. That moved up to 3.75% at the June meeting, indicating a much more hawkish stance by the majority of the FOMC members. Now, will we actually get a hike by December? That is still to be seen. But with at least one hike currently priced into markets, what it essentially does is it is going to help to limit upside risk to rates, which I think is a pretty good transition into our conversation around fixed income markets. So getting into fixed income, let's go ahead and start out with performance. In terms of investment grade bonds, returns here pretty mediocre thus far in 2026. So we have the Bloomberg Aggregate Bond Index that's up just 67 basis points year to date, and the bulk of those returns they actually came in Q2. I think this really speaks to what we've said on prior quarterly calls. Treasury yields they do look pretty attractive at current levels, and even if rates rise, which they have over the last few months, your coupon, it is going to be there to protect you. And that's exactly what's played out thus far in 2026. Now, outside of core US bonds, there have been a couple of standout performers. So the first is going to be munis, which we don't tend to talk about that often. So munis, they underperformed by a pretty wide margin last year, but they have seen a pretty notable turnaround so far in 2026. This is going to be largely driven by a couple things. First is just yields increasing in general, but probably more importantly is that increase that we've seen in tax equivalent yields, which has driven near record flows into muni funds in the last quarter or so. Now, the other asset I want to touch on, that's EM local bonds. So they were a big winner last year. They gained nearly 4% in Q2, and they've really benefited from their beta to just emerging markets and emerging markets equities in general, which, as we'll see in a couple of slides, have performed exceptionally well so far this year. Now, digging into fixed income markets a bit, we have seen rates move up across the yield curve in 2026. However, the front end has been disproportionately impacted. There's a few reasons for this. First is inflation expectations. As we saw in that break-even slide, concerns around Iran have disproportionately impacted short-term inflation views, while the long end, that has been relatively stable. And then the second factor, it's going to be the Fed. While their policy decisions are going to impact the curve as a whole, what they do tend to do is disproportionately impact the front end of the curve because they are setting a short-term rate. And the long end of the curve is going to be more concerned about where rates are going to be in the future. So what this has resulted in is a pretty dramatic flattening of the yield curve. Now, we're still a bit away from being inverted, which is where we were just a few years ago. But coming into the year, we saw both the 210s and the 230s pretty close to their long-term historic averages. And I think that the next logical question from here It's going to be what implications does this have for your fixed income portfolio? And honestly, I would say not that much given how we're positioned today and any changes we've made to our positioning. So, looking back to when the curve was inverted, there was clearly an opportunity at the short end of the curve. The curve needed to steepen, which happens with short rates going down, long rates going up, or some combination of those two. And really, in any of those scenarios, you would most likely win with an overweight to the front end of the curve. Today's environment's a bit different. So we are still seeing some positive slope to the curve. So you are receiving a positive carry for taking on duration risk. And then additionally, at an absolute level, yields at the intermediate and the long end of the curve, they're about as attractive as we've seen in the last 20 years or so. And that's what we see in this chart on the left. So if we do enter a period of economic weakness or just equity market volatility in general, one that's obviously not inflation related, you are likely to see that diversification benefit return from owning bonds that was not there in 2022. And then the last takeaway from this slide that I just want to share, and we've shown this before because I think it's pretty powerful. Your future fixed income returns, they have been highly correlated with your starting interest rate. So with what we view as limited upside risk to rates from here, investors can realistically expect an annualized return over the next, say, 5 to 6 years of almost 4.5% from their intermediate term treasury holdings, which again is one of the most attractive return opportunities that we've seen in quite some time. And then lastly, on the fixed income side, just to finish up with credit markets, we're still seeing very little value here because unlike treasuries, there is a good deal of tail risk. Despite the volatility surrounding the war, spreads are basically right back to historically tight levels. Right now, you're receiving around a 2.7% premium over treasuries, but that's essentially your return cap from here. Best case scenario is likely coupon clipping, assuming spreads stay relatively stable. However, if spreads do widen, you're looking at potential losses for your high yield bond position and potentially outsized losses if we do get a large move upward in spreads. And just to put some numbers around that, if we were to just assume spreads move back out to their average, right now you've got a 7% yield or so, you've got a 3% duration. That puts you at a total 12-month return in the range of about 1, 2, 3% or so. And if we were to move out to 2016 levels where spreads were at 700 basis points over treasuries, you're looking at a total return of roughly minus 5%. Now, comparatively, in a similar environment, you're likely looking at gains from your treasury holdings with significantly less risk. Now, moving on to equities. So global equity markets posted one of their strongest quarters in recent memory in Q2, fueled by a really strong Q1 earnings season and those easing tensions that we saw in the Middle East. The S&P 500 posted a return of 15.2%, marking its highest quarterly return since its 20% post-COVID snapback back in the second quarter of 2020. Gains here relatively widespread across the style box, even though most of the news that we saw surrounded the AI and semiconductor trade. Value stocks actually turned in a quarterly return of nearly 14%, which only trailed their growth counterparts by around 3% or so for the quarter. However, what's kind of interesting is large caps, they were not even the top performer in Q2. Small caps turned in a near 21.5% return. That corresponds to their best quarter since Q4 of 2020. Small caps benefited from a number of things. One, attractive starting valuations versus large caps, economic resilience with the U.S. economy still being on relatively strong footing, and then also it wasn't just large caps that saw strong earnings in Q1. Small caps came in with lower expectations and really didn't disappoint. And what I think this really did is it essentially helped to entice investors for the first time in quite a while to start to look outside of the Mag 7 for some potential value and growth, and that's kind of what you saw in Q2. Then if we look outside of the US, emerging market stocks, they were really the standout performer. They rocketed higher by more than 24%. And you'd actually need to go all the way back to 2009 to find a stronger calendar quarter of performance. Now, emerging markets, they benefited from a good number of the same tailwinds that small caps did. But one interesting thing there, though, is you also saw a boost from their exposure to the AI supply chain, and more specifically, Korean semiconductor names like Samsung, SK Hynix, they soared in Q2, and this has been a trend that we've seen for much of the last year or so. And then lastly, just to touch on commodities. So commodities were really the only major asset class to find themselves in the red. This is largely driven by lower energy prices, which weighed on returns for the entire commodities complex. So at the end of the day, looking at the benchmark Bloomberg Commodity Index, that was down 8% on the quarter. And like I mentioned already, the only major asset class on this slide that actually found itself in negative territory in Q2. So let's get a little bit deeper into the key topic for this quarter's equity section, which is growing concentration risk within markets. As I mentioned on the last slide, leadership did broaden out in Q2, and it has for much of the year for that matter. But the top heavy nature of today's indexes continues to be a growing concern. And the concern here is the risk to investors who believe they're truly diversified by owning a simple market cap weighted index. And the reality that is that that just isn't true in most cases. So on this slide, what we're simply looking at is the historical makeup of the top 10 largest names for a variety of different asset classes. So what I want to do first is just start with the good news. So if you own a market cap weighted US small cap or international developed ETF, you're likely in pretty good shape. Concentration within the small cap space, relatively benign. And even in a large cap index like the Bloomberg Developed Markets Index, your top 10 names are only going to account for about 13% of your portfolio. However, when we step into US large caps, this is where we start to see some concerns. So as of quarter end, the top 10 names here accounted for more than 35% of the index's total market capitalization. And those names tend to really be contained in, for the most part, the same sectors, which are mainly going to be technology and communication services. The lone exception here is going to be Eli Lilly, which barely sneaks into the top 10 with a weight of about 1.5%. Now, the other names in the index in the top 10, they're either going to be major tech players, hyperscalers, or semiconductor manufacturers, all of which are going to be highly tied to the AI trade, and many of which come with some pretty lofty valuations. Now, should some froth come off the AI trade, which we've seen spurts of throughout 2026, this really opens the so-called quote unquote diversified investor up to some potentially unwelcome surprises. Now, emerging markets, they aren't immune to this either. They suffer from many of the same biases embedded in the US markets. In prior years, investors expressed concerns about China accounting for too much of the index. Today, it's really Korean and Taiwanese chip names who dominate. So Taiwan Semi is going to be a whopping 13% of the index. Samsung is over 6%, and SK Hynix is 5%. Do the math, and those three names in near identical industries make up nearly 25% of the entire emerging markets universe. So definitely some concerns there. We'll get into that a little bit later in the equity section of the presentation. Now, I alluded to this already, but the largest risk that this presents is the potential negative impact to diversified investors should the AI trade start to unravel. And this could simply be due to concerns over valuations or something more fundamental like massive CapEx plans not translating into profits. And we'll get into that last concern in the next couple slides. But what I want to do first is just focus on the impact that these names have had on returns over the last year. So on this slide, we're looking at 1-year performance attribution for the S&P 500 and the Russell 1000 growth indexes. And the trend is a little bit concerning. So if we start with the S&P, if you take out just the top 7 contributors to the index, they accounted for more than 60% of the index's return. And the results are even more skewed if we go ahead and look at the growth index. Over the last year, the top 7 contributors were almost the entirety of the index's near 19% return. If we look at this, the remaining 490 or so names, they contributed just 1.6% to that 19%. This works well for investors when these names are doing well, but it can definitely spell disaster if the trend does happen to reverse itself. So, looking at some of those risks related to the AI trade, the first surrounds massive capex plans and how that impacts future cash flows. So, on this slide, we see the aggregate free cash flow for five key hyperscalers. Up until recently, these companies were throwing off an unheard of amount of cash, largely due to strong profitability and record earnings. However, as we look ahead, all of these companies have announced and are undergoing huge capex spending plans to further build out their AI infrastructure. This has completely flipped the script. So we went from a high of nearly $300 billion of free cash flow at its peak back in 2024 to an expectation of negative free cash flow over the next 12 months as of the most recent quarter end. Now, it's not abnormal for companies to invest in growth, but the risk here is what happens if that growth doesn't materialize, or the more likely scenario, what if it doesn't pay enough or pay off soon enough for investors? And that's what we see here. So we're looking at profit margins for both the Magnificent Seven and then the S&P 493. And the question is, what trend do we see here? So profit margins for the Mag 7, they've soared to record levels over the last few years. However, margins have been strong but relatively flat for the other members of the S&P 500. So this brings up the question, isn't this a positive for tech and AI names? Well, it's actually quite the opposite. So, a lot of the valuation premium that's currently baked into the technology sector is based on expectations that AI will create huge productivity gains and profitabilities to the economy as a whole, not just tech and comm services names. If investors don't see these gains in the near term, it could lead to a pretty troubling divergence between high valuations in the tech sector and free cash flows that don't materialize from these massive spending plans. Investors faced a pretty similar reality in the early 2000s. Yes, the internet changed everything, but it didn't do so immediately. And once this became a reality, those stocks and sectors priced for immediate gratification, they were inevitably punished by investors. So I guess the question is then what can investors do to avoid these risks? Well, I don't want you to completely avoid growth names because they are a key component of US markets. But what you can do is focus your portfolio on other assets where valuations look much more attractive and that are less levered directly to the AI trade. This can also greatly help to reduce your concentration risk. And we have a couple asset classes laid out on this slide that we currently favor across our strategies. So what we're looking at are relative valuations across a number of asset classes going back roughly 30 years. You're going to see a near historic opportunity in both large and small value names. In fact, valuations today for those two asset classes, they're going to be eerily reminiscent of 2000, a period where these assets went on to perform relatively well despite the bursting of the technology bubble. And the third asset class is US high quality equity. So you are going to get some tech exposure here, but in general, it's going to be less top heavy than broad US large caps. And you're also going to be avoiding exposure to highly levered, lower quality names that are likely to experience the greatest drawdowns in an environment where valuations are being repriced. Now, switching gears and looking outside the US, I mentioned earlier that the concentration issue is not just a US problem, it also resides in emerging markets. And just to further illustrate that point, here again, we're looking at 1 year attribution. At the top of the slide, we have the MSCI EFA index. That's really just here for a point of reference because this asset class illustrates what diversification and broad leadership actually looks like. So outside of ASML, no single name accounted for more than 1% of the index's 1 year return, and nearly 75% of the return comes from names outside of the top seven contributors. EM on the bottom, however, that's a different story. So over the last 12 months, the index has gained 42.5%, with about three-quarters of that coming from just the top seven names, and nearly two-thirds of its return coming from its three largest holdings. Those are going to be Taiwan Semi, Samsung, and then SK Hynix. Now, this problem can be solved relatively easily, and that's through index selection. So the MSCI index family, they categorize Korea as emerging. FTSE categorizes Korea as developed. Strip out Korea, and your returns are still a little bit heavy, but much more diversified. However, in our opinion, I think the best solution here is to look at valuation. So here you see emerging markets valuations compared to the US and EM value compared to EM growth. While EM as a whole looks inexpensive compared to US stocks, it's really EM value where the greatest opportunities lie. So there we see a near historic opportunity from a valuation standpoint. Now you're still going to have exposure to Taiwan and Korean tech, but you'll be owning those names uh, in Korea and in Taiwan with more attractive valuations. Just to give you one example, for instance, one of the largest differentiators is SK Hynix. So SK has a weight of nearly 8% in the standard MSCI EM index and a corresponding one-year return of about 700%. In the value index, it doesn't even crack the top 10. So you're getting much more diversification, less concentration, and you're focusing on a set of undervalued assets and undervalued companies versus that standard index. Now, lastly, moving on to real assets and alternatives, starting with commodities. This is a position we had owned throughout the first 4 months of the year, but removed all of our exposure back in late April. This was largely due to the near 40% or so run up that we saw in the asset class, which essentially cut our future return expectations in half. We'll see that in a few slides. But focusing here first, we can see that Brent crude prices have fallen meaningfully since resolution to the Iran conflict started to become a reality. We're not back down to pre-war levels just yet, but we are relatively close at this point. You can also see this priced into futures markets with prices at the peak expected to drop meaningfully by year end, which is precisely what happened. And now we see the curve is a relatively flat shape. That said, still an asset class to monitor given the recent pullback we've seen. But given that this is an out of benchmark position for us, we need to see our conviction grow pretty considerably before re-entering the asset class. And then just finishing up with closed-end funds. Closed-end funds saw positive returns for the quarter. Discount action, though, relatively benign here. The average fund entered Q2 trading at a discount of 5.7%. Ended the quarter with an average discount of 5.1%. Municipal bonds, really the key driver of this. Discounts within the muni space tightened by about 100 basis points on the quarter. This was really driven as investors were enticed by those attractive tax equivalent yields. Discounts for taxable bonds, they also narrowed a bit, but they still remain nearly 200 basis points wider than where they were prior to the Iran conflict. So as a whole, universe looks slightly cheap compared to fair value, meaning that opportunities here are going to be a bit selective. That could, however, change pretty quickly if we were to see an uptick in overall volatility or a widening of credit spreads. And then just tying all this together, we'll just quickly walk through our asset allocation return forecasts and then current strategy positioning. So if we start with our long-term return expectations, we've seen return expectations reduced across the board due to strong performance. However, that order still relatively unchanged. You're going to see non-U.S. assets, high quality on the right-hand side, U.S. large growth all the way on the left. The only outlier, that's going to be commodities. So their expectations have actually increased due to the recent pullback. However, coming into the year, we did have that asset class with an expected return in the range of 8 to 9%. So we're still well below our range of kind of peak optimism or peak conviction around commodities. And all this is going to translate into our strategy positioning. So we've got a pretty sizable underweight to U.S. stocks as a whole. And within the U.S., our most meaningful tactical position is going to be an overweight to U.S. value, with that value positioning being largely focused on attractively valued, deeper value, and higher quality names. Outside of the U.S., we've got a meaningful overweight to both international and emerging markets value. The largest change on the quarter comes in the way of commodities. Like I mentioned earlier, we fully removed our position in late April. Those proceeds were then allocated back to our other equity holdings on a pro rata basis. And then lastly, on the fixed income side of the equation, no change here from an asset allocation standpoint, still favoring emerging markets, local bonds. We still have a generally neutral duration position. And then we also have an underweight to corporate credit, which is largely going to be a byproduct of the current spread environment. And with that, that does it for this quarter's Market Insights presentation. If you enjoyed the presentation, please feel free to like, share, and subscribe. Also, if you have any questions or would like to learn more about our product offerings, please feel free to reach out to a member of our advisor services team. You can see all of their contact info as well as our website address on this slide. Thanks for watching, and I hope to see you again next quarter.